Usually your largest investment and financial obligation tends to be your home and the mortgage that goes along with it. Now, with the mortgage, of course, that could cost you tens, if not hundreds of thousands of dollars over its term, and it can build equity slowly. Now, early on, the reason for this is early on, most of the payments that you make on your mortgage go towards interest rather than principal. And a lot of folks want to save some money on their mortgages and want to accelerate the growth of equity in their home, especially those folks that were not able to make a 20% down payment and are having to pay PMI in addition to their regular monthly payment each month. I've done another video about that if you want to go check that out. But as far as building equity in your home and saving money and interest, there are largely two schools of thought. One revolves around simply making an extra mortgage payment each year versus those that aspire to the idea of shortening the term on your loan. Now, the myth of the extra payment versus the shorter term is something that is debated about quite a bit. But the way the myth goes is that you have to start early in order for it to have the most impact. It works best on a 30-year loan. And the myth goes on to claim that it could save you tens of thousands in interest over the life of your loan and pay off your loan up to 7 years sooner. Now, the truth of the matter, and the reason why people aspire to this is because of flexibility as opposed to shortening the term of their loan from, say, 30 down to 15 years. That's usually the common trade-off. The reason I say myth is because, first of all, the flexibility that the extra payment plan offers is, and if times are tough, you can, forego making the extra principal payment each month or hold off on making the extra payment this year and use that money elsewhere. The truth is that in these situations, it rarely ever works out. Usually you can, once you start rationalizing not making that extra payment, you continue to rationalize that not making of that extra payment. And so you end up being stuck for 30 years in a 30-year mortgage, which is the exact opposite of what people were trying to do. The other reason why I say myth is because if you drop the term of your mortgage from, say, 30 down to 15, you also tend to save because of a lower interest rate. And so that could be beneficial to you. I just got caught chasing this rabbit. I don't have a shotgun. I'm probably not going to catch him. All right. So a lot of times the lower interest rate that you could get in a 15-year mortgage versus a 30 is about 0.5% or more, which can be significant. Now, I actually took the time to crunch the numbers because I know people are going to argue with me. There's people that are going to say, oh, no, I've been making the extra payment. It's been going great for me. Okay. Well, I looked at a $200,000 mortgage, over 30 years, assuming a 3% interest rate. Your mortgage payment, principal and interest only, mind you, is going to be $841 a month. That doesn't include escrow, that doesn't include taxes, insurance, or that dreaded PMI payment. We're just trying to look at apples to apples here. Over the life of that loan, it's going to take you 30 years to pay it off. You're going to pay around $103,554. And I'm going to attach a mortgage calculator that actually takes into account extra payments in the link below this video on YouTube so that you can play around with it yourself. Okay? Now, if you make an extra mortgage payment a year, wow, there's a lot of zombies here. Hope I can get past these guys. Well, if you make an extra mortgage payment a year, well, you're still looking at a $200,000 loan. You're still looking at a 30-year term. You're going to make roughly an extra $70 payment each month. So instead of $841, you're going to be paying $911 each month. You're going to pay about $90,000 in interest over that loan. You are going to pay that loan off 3 years and 6 months sooner. You can already see that that myth is blown up. It's not the 7 years that you were led to believe. So your sum total in savings is I guess technically going to be tens of thousands. It's going to be $13,000, $13,533. So it is a 10 of thousands, but not tens of thousands of dollars, like you may be led to believe if you fall for this myth. Now, by the same token, if you shorten the term from 30 years to 15 years, so you've got a $200,000 loan, you've shortened it to 15 years, you're going to save a little bit in interest, as I've already mentioned, because you're going to get a lower interest rate. So if we look at 2.5% as an interest rate on your mortgage, your monthly payment is going to be $1,333 a month. Over that 15-year period, you're only going to spend $40,044 in interest. I read that correctly. I've got it right here on a whiteboard in front of me. $40,044 in interest, thanks to half of the term. So therein lies the difference, guys. Therein lies the benefit to you in taking a shorter term loan versus making an extra house payment a year and doing a 30-year mortgage. The other thing is, psychologically, as you are watching those numbers, as you are making your house payment each month, man, you will be shocked at how quickly the principal just drops like a stone. It is crazy. How do I know? Because that's what we're doing. We had a 30-year mortgage on our home, and we refinanced to a 15-year mortgage so that we could start to see some of these benefits ourselves. And guys, it is huge. And of course, that's what I want for you guys. That's why I bother to do these videos. Now, just to drive home the point, I want to make it clear that a 15-year versus a 30-year mortgage saves you $63,000 in interest, versus the extra payment a year plan, it saves you $50,000 in interest. And of course, versus the extra payment a year plan, your home will be paid off in 11 years, 6 months sooner than the extra payment plan. The downside is the extra cost in a house payment for you. You're going to pay about $500 more a month. Or $430 more a month than the extra payment plan. But guys, huge difference. Now, just in case you were doing this method to try and get rid of PMI, I took the time to crunch those numbers as well. I'm sorry, I've got that on a notepad, so I've got to stop and look here. So, in order to get to that 20% equity threshold, assuming you didn't pay any money down, a 30-year loan, it's going to take you 8 years and 7 months before you've built up 20% equity in your home. An extra payment, it's going to take you 7 years and 3 months. So it's going to save you about a year and 4 months getting to that 20% equity so that you can drop that PMI. Usually that runs you about an extra $119, I think, on a $200,000 loan. But a 15-year loan, same deal. You didn't make any down payment. It's only going to take you 3 years and 6 months to build 20% equity in your home. Now, granted, you're paying an extra $6,000, $5,200 a year over the extra payment a year plan, but it makes a huge difference. So if you're trying to get rid of PMI, if you're trying to save money in interest on your home, if you're trying to build equity faster in your home, hopefully I've made it clear by now that reducing the term of your mortgage is the way to go to do that. Now, I'm going to bounce out here and grab this crate real quick. Guys, as always, if you have any questions, hit me with it at fustyandfinance@gmail.com. And, of course, you can leave them in the comments below the video.